how weak they were, but you could still make some type of bullish case on this when you look at the daily, that, this was, when you look at this, that this could have just been ABC, and now we're going to blow. So that's yields are up a little bit today, and that's why you have the NASDAQ down 30 with the S&Ps up 16. So what do you think about the S&Ps? Think that's it?
I don't know. It was a bit of a funny day Friday, wasn't it? I mean, you've got that NFP report, which headline miss, but the rest of it underneath was okay. Unemployment rate, participation rate. Okay, wages were a bit softer as well, but you've got to expect that as more people come back into the market and get those jobs. The lower paid jobs pushes the average down, so that's natural. But the S&P, again, potentially got that solid bottom around the 4,500. That's your marker.
It is, yeah.
What do you got to look at perhaps 4,600, 4,620 to get above to turn it around.
Yeah, I would. I'd be trying shorts up here, long over the high of the move, or you'd finesse it. But I would try a fib retracement. And even though it's been down, it hasn't been an easy down. Kind of reminds me of crude. On the first wave down, it was choppy down. You had this. It didn't make it easy until this. On a failing rally. So maybe that's what the S&Ps need, is a failing rally, and then it gets easy.
Yeah, a bit of a pivot. S&P's around this 50, 60 area, isn't it? Doesn't know what to do around the middle here.
You're finally getting a pop in Aussie.
Yes, at last.
What do you think? At last,
well, not much of a pop, but give or take, whatever it was, 7-8 pips. I'm calling that a hold at the 70 level. It flushed out whatever barriers were there, if there were any. But 39s, 40s, not exactly a huge bounce based on that trend that we've seen there.
Yeah,
I want it up at least over 71 to look like this is turning around.
And Canada, I don't know. It's been pretty stubborn, but it has turned down from 78.6. I told some of my mentees Saturday that I'm done trying to top pick Canada for a while. Wait for the dollar to get to wherever it's going to go. It's a tough call, but this kind of action, the dollar is kind of not the best trade.
Isn't it? Yeah.
I wish it would just blow off already, get it over with. 97.5, 98 is still viable, I think. And Stell, how are you? Are you around? I know Steve's not feeling
good. I'm getting my third jab on Wednesdays, 2 days.
Who would have imagined 1 year ago? First of all, we didn't know if we'd have vaccines a year ago, right?
True.
That we would have had 3 jabs within a year.
Yeah. Well, it is what it is, and we try to protect ourselves.
Is Omicron, whatever it's
Omicron
called, what's going on in Europe? It's I heard they're canceling, big companies canceling all the big holiday festivities, and there was an article about a caterer who said that it was going to be better than 2019. And now it looks worse than 2020.
It depends on the country. Some European countries are more draconian than others, but bottom line is this variant is everywhere. I mean, they're discovering cases, but really, I think it's probably been around for a little bit now. And the question is, if this is the way that scientists are presenting it so far, then it could be the beginning of the end for COVID, because it could be that this gets everywhere very quickly. And because the symptoms are relatively mild if you're vaccinated, then, people can, the economies can slowly get back to normal. But, we don't know. I don't know. Does anybody know? I mean, I don't know. So
finding out this week, aren't we? We should start getting some of the pharmaceutical companies coming out with their efficiency rates and seeing whether the vaccines are being hit that bad or not. So fingers crossed for that.
Yeah.
So we wait and see, and until then, I think it's going to be, markets are going to be a little bit, how should I say it? They're going to be delicate, and one day it's going to be, oh yeah, things are good, then no, things are bad. We've seen this for the past few weeks or a couple of weeks, and it's down 2% one day in stocks, and then up 1% the next day. So until then, I think we have to be on a holding pattern. I think we are getting to the point where we've been saying that stocks are very overvalued. If any metric you look at, they're overvalued. But as long as there's still a accommodative monetary policy, well, nothing's going to change. But we're getting now to the point where a lot is, a lot of, how should I put it? There are many reasons now coming up that could cause markets to go down. I mean, the main one is the Fed continuing with the taper and hiking. If they go through with it, then I don't think markets are pricing that in. So, and also there's always the chance that Omicron is not as
mild,
as benign or mild as people say, or the next one, F.A.C.E, whatever, Omega, there it's worse. Who knows?
All the Greeks, isn't it? All you Greek lot.
Is there another one of concern already?
No, I don't think so. I just made that up. But
Right.
until then, it's very difficult, and you know that if you're taking positions in equities, you're risking. It's a big risk either way, and you're as long as you have a valid reason why you're taking a trade on, or why it's a nice technical setup or something, that's fine. But in terms of macro space, it's clear as mud as far as I'm concerned. So.
Yeah.
So
December is a new October.
Yeah. Yes,
I mean,
exactly.
it's normally a pretty quiet, uneventful month, and a lot of stuff happening when people are closing the books, and a lot of people, that's all they're doing is book squaring, getting ready for next year.
Yeah, I was listening to Jim Welsh's interview that we posted on Trade the Summit just a little bit ago. Blake did that on Friday, and Jim Welsh is, I really admire his work. I think it's really excellent, and he's very bullish. He thinks that there's a chance that the Fed might increase the taper to 30 billion. And because, this is a chance, and they've lost a lot of credibility with the whole transitory thing not really being transitory. So this is a chance to actually do something right. And, if that happens, they say, right, we're going to go to 30 billion, and that's going to take the taper out completely, done by March. I think the markets are definitely not ready for that.
Jim called and Jim's not a permabull. He called that pullback. And I've seen some of his stuff. He's looking for a new high in January, and then a bigger pullback. And then he's saying by mid-year, that's when the market could really, the structure, the underpinnings, everything could be in big problems.
Yeah, so, could well pan out like that. Yes.
Well, he's pretty old. He's seen a lot of this. He's my age. Yeah. So,
but so risk assets is very difficult. The other thing which has been in the foreground the last few days is cryptos, and they've pulled back. There's still, very good gains on the year, and that's what crypto fans are saying. Look, they pulled back, but look, they're up, 50% or whatever it is on the year. Yes, of course, but you can't deny this move, and the support. There was support at 53,500. We just went completely, and then we touched. Actually, Bitcoin is trading quite technically. It did touch that. There was another zone around 43,000. That's where it found support. There's you have a 38.2 around there. Yes. So, it was, we get a glimpse every now and then when everybody wants to get out, because remember, there's so many people who are well in the money in these, who've gone long a long time ago, and, including people like Michael Saylor, who's, I think his average is around 30,000. But he has huge size, if he ever needs to get out, good night. But, when everybody wants to sell, then look at this, 20% move in 24 hours. That does not characterize something which is a store of value, at least not in my books.
Yeah, but, I heard someone compare Bitcoin's action to NASDAQ's action, that it's mimicking NASDAQ. Maybe in a way. What do you think?
10 times size of movement.
Beta. Yeah.
Yeah, but yeah, it's a great vehicle for speculation and to make money quickly or lose money quickly. But there's so many other arguments that I don't buy. But that's me.
Yeah, yeah.
So it stores value. It's just
make
liquid, tends to evaporate. Yeah.
Liquid.
Anyway, yeah, nice one, Dom. But yeah, so it's. I think we're now waiting for the December FOMC to see what they're going to tell us and what they do with the taper. And again, we're going from one event to the next, kind of waiting and waiting. It was Friday's payrolls number weak enough to make the Fed reconsider their path? Probably not. Probably not. But so I think they're on target to do what they want to do. The question is, once the market realizes, look, okay, they're going ahead with it, then it's going to start reacting, and then we're going to see how equities go.
Yeah. I think the December meeting's either going to be we get something on if they're going to go faster, or they'll just kick the can into next year.
Is it this week or next?
Next week. That works. Yeah. Okay. 2 weeks. Sorry, 17th, 18th.
Yeah, mid December, 15th, 16th.
Oh, interesting. Okay.
We've really only got 2 weeks. 2 weeks of trading left. By the time we hit I think Friday's the 17th.
Yeah.
The week after that is Christmas, more or less.
Right. Yeah. We have partial weeks. Yeah.
And we have those online Christmas parties.
Well, I'm ready for January. I never like this time of year to be doing much trading. You've been at it hard for 11 months, and it's almost like so many cross currents at this time of year. To see the January effect. Anyway, so end of year flows, does it favor the dollar?
I don't know yet. I think we got to wait and see, look at the performance over the year. Match it all up against everything else. We'll probably start to get all the models coming out over the next couple.
Oh yeah, where's that going to be? I want to see all the models.
Yeah, we usually see them in the
models and bottles.
Those models.
I mean, if I didn't hear about that, Ryan. Where's the location?
There's a queue.
Anyway, so
I see Blake heard about models and he's unmuted now. See, he's ready.
Hey, I'm ready to go. Whatever you guys are talking about, I'm in. How you guys doing today?
London thing.
Good,
Blake.
Good. Well, hey, I want to, first of all, you guys were talking a little bit about just a little bit ago. I just popped in about about the FOMC and about the jobs data, and I just posted that interview from with Jim Welsh that you were talking about, Stelios, where Jim was talking about the jobs data. And the jobs data, even though the headline number was weak, it's important to understand like what was happening underneath the surface. And then so if you're wondering why stocks didn't sell off the stocks actually following that data, the stock market kind of went down. It's because the data wasn't bad. I mean, even though the headline number was bad, it's actually good data. So it's not going to deter the Fed. You know what I mean? Well, at least that's the idea right now. We do have inflation this week. I do think that's going to be a market mover. But I wanted to really, talk a little bit about what you guys were talking a little bit earlier about how this variant is going to affect activity. Like, and I have to reiterate that the US is a lot different than the rest of the world. You know what I mean? So it depends where you're at, but a really good gauge of this is my wife's business. My wife does you guys haven't heard me talk about her business in a long time. So some of you probably didn't even know that she, I actually never talk about it. So let me just tell you what she does, so you guys can are familiar. So this is her company. She started this years ago. This is all like curated Arizona stuff, like by makers too. Like this little cutting board is handmade. This is from Olive Mills here in Arizona, and all of this stuff is all Arizona stuff, right? So she curates all these gift baskets, right? And boxes. You can build your own, you can grab, whatever stuff you want, all this, this local stuff. It's basically the anti-Amazon, if you will. Like whatever Amazon is, my wife is doing the exact opposite of Amazon, right? The reason why I'm showing you this is because she gets a lot of business from corporate events. We're in Arizona. So being in Arizona, we have like literally 3 or 4 months where no one does events because it's so hot. But other than that, the 7-8 months out of the year, it's just gorgeous. So that we do a lot of, people come to Arizona and they come to play golf, hike the mountains and do corporate events and weddings. That's all it is. What she's found is her event business is really, really picked up a lot. And Dale, you were mentioning something about some people were expecting
in Europe, they're canceling all of them.
Yeah. Remember here in the US, we're much different. And that's why, you have to be really careful about being too bearish, the economy with this variant. I think it's gonna be very, dependent on where you're at. But if you're really betting against the US and and you're thinking about, oh, it's this variant, blah, 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 be really careful with that. My wife's business is, and I'm just giving you a good example because she does a lot of corporate stuff. They're planning things going into next year. And they have really taken the last year and a half off. And so it's a really, I use her business for a gauge for a lot of things because I get to see what suppliers are doing and, how the supply chain is working because everybody's trying to order the same stuff from China, boxes and jars and all that same thing. And I can see where the bottlenecks are at. And I talk to her all the time, obviously. So it's just really, it's interesting. I think the market, or I think the economy is normalizing. And Stelios, I believe you're right with your comments earlier, talking about the Omicron as of right now. We're seeing that from the data that it's getting less and less severe, which I was reading something from FX Macro. For those of you that don't know, I traded for I traded for Gelos for like 3 of the last 5 years, and then the 2 years before that I traded for his partner and their other group. But he pushed something over that this is typical of these types of research said that these COVID variants, as they come out, they become less and less
virulent.
What?
Virulent.
Yes. And so that's a great way to describe it. So it's just, be really careful. This might be, I think what they, say it's like, we're nearing the end of this COVID, which makes sense. It's been around long enough and, it's affected our lives long enough. And hopefully, we're on our way to normalizing our world. And I tell you, I was at a soccer tournament all week long. And, I just, where I live, it's very normal living. I mean, you don't, pretty much. So I don't know where you guys live, but I want to show you a couple of setups with currencies. So here's the euro dollar. If you guys are expecting the euro to move, we are really stuck in this really tight range. So just realize that we have a breakout looming here. As I think Ryan mentioned a little bit earlier, he expects the 112 level to hold. Me too. I expect any dip to be bought in the euro. I think we might be developing an inverted head and shoulder pattern, or the middle finger pattern, or the PP pattern, whatever you want to call it. We have a little, we're kind of developing here. You can see the breakout points are very clear. I know you guys talked a little bit about the Aussie. I have started establishing some longs down here, and I'm looking to become more aggressive too. If we can get back above 71 cents, back above this breakdown point, you guys probably know already from the week ahead video. I feel this is a generational low. I've been looking to buy this 38% retracement forever. I bought it Friday afternoon. some people asked me how I traded the Aussie post non-farm payroll, because I bought it. Remember, we were live on air during the non-farm. I picked up some right here, about right there, somewhere in the 70s, and then I sold it for a loss somewhere down here. And same with the euro. I took like a 10 or 15 pip loss, and then I started buying the Aussie down here, and I'm long. Much more aggressive at these levels. So that's kind of how I'm trading. And if you missed the 70-cent level or the sub 70-cent level test, I mean, we closed at like 69.90. We were there for hours on Friday, but yeah, I was establishing longs there, as everybody in the chat room knows. So but this trade has been planned for a long time. There's something to be said for that, guys. Wouldn't you agree? I mean, when you trade, when you set out a plan of action, like something in motion that you've been waiting for months. I mean, what happens? How do you treat it when you get there? I'm going to ask you guys, Stelios and Ryan and Dale, like you've been planning something for months. Like I've been planning on buying. You guys have heard me multiple times over the last months. I've been waiting to buy the Aussie at 70 cents, and it came on Friday, but stocks were down, dollar was strong. And, at the time, I'm like, am I making a mistake? I mean, I thought about that. It would have been stupid for me not to have, right?
You kind of answering the question yourself, Blake. So
yeah, but I gotta ask, like, this is what the candle looked like. And I'm like, but I've been planning on it. And I said, well, F it. I'm buying it. I have to. So, what do you guys, how do you feel when that happens?
The way I treat things is I have an idea. I know where I want to be trading something. For example, I always said I want to be buying euro pound at in the low 83s. It didn't get quite to 83.1. I had my target. It got to like 83.8. So I haven't done it yet. But basically, once something gets to where I want it to be, I will look at other factors that might be affecting this trade. So you said very correctly, and you're looking at the Aussie dollar, but you have to look at stocks. You have to look at the yields. You have to look at what the dollar is doing in general, all sorts of things. And if everything is pointing the same way, I always scale in. So if everything's pointing the right way, I scale in aggressively. If not, I scale in slowly.
Yeah, put a toe in the water. That's what I do. I'll put a toe in the water, so I'm paying attention.
Yeah, and we call it. Dale's heard me over the years say this. I put in trackers a lot.
Yeah.
This time, because I had been planning on it for so long, I'm actually, I've got a pretty decent size, and I want it to be. I actually want it to be bigger than my normal size. Meaning that let's say I normally trade 10 lots. Right now, I'm already at 8, and I've got people have seen my average because I put it in the chat room. I'm only up 27 pips right now, but I plan on having even more aggressive than normal. Cause I consider, again, I'm just using a round number here just so everybody can have a basis of kind of what to do, because what I trade and how I trade, or the amount of money that I trade and the dollar amounts that I trade, are much different than everybody else here. And it's not saying that it's more or less. It's just, we're all different. Right. So I try to give everybody baseline. Like if I normally trade 10 lots, that's my average. That means that, if I'm trading like a half size position, I might only trade 5 lots, or, I trade a third size position, I'm only trading 3 or 4 lots. Well, right now I'm already 8 lots and of my normal 10 size. And if we end up getting a false breakdown, I'm going to be more aggressive going back up towards the 73-cent level, because that's going to be a false breakdown. That's going to be a major respect of the support zone that we all know. And that's really how I'm trading at this point. And I'm sorry, Ryan, we didn't get your answer. So what do you think here? How do you approach those types of situations?
It's twofold. This is where you match the long-term thinking with the short-term action, because, we were talking about this, September, October, when we had a move down to 71 and below. When you're at 75, 76, everyone wants to buy at 70, but it's when you get there, that's when you have to do it. So you have to weigh it up. On the techs, it's a fantastic level. It's a huge level on the way up. It's going to be a huge level on the way down. So far, it has been.
Yeah.
But when you get to that point where it's happening, you've got to look at what's the driver. Now, what have we got? We've got a trend lower from the 75, 76s that's been running for over a month now. That's a negative factor. On the other side, what's causing the move? Well, it's a bit of virus, a bit of NFP coming in, stock weakness, like you say. But those components, in the grand scheme of things, NFP isn't going to change the Fed's mind. The virus is looking like it's going to be mild, but we've still got to wait and see. The excuses why it's down there are pretty small and short term. So then you've got to think, right, in one hand, I'm looking at this long term. I'm looking at a big, strong technical level. What could go wrong? The data that's coming out, stock weakness, is that heavy enough to cause me to not do that trade? And then you've got different gradients, because you can think, well, I'm a bit more nervous about it. I'm not going to go in as big. Or you think, right, well, it is a huge level. I'm going to go in bigger because I've been waiting for this level. The news isn't that bad, and on we go. But I mean, I've been scaling in long since 75. I probably did that way too early. I got too excited. I'm long.
Wait, you've been scaling in since 75?
Since 75.
Oh, 70, 75. Got it.
No, 75.
75 cents?
Yeah.
Like up here?
Yeah, remember I was telling you about I want to fight the RBA next year?
Oh, you wait, because I was just going to say, if you remember the week ahead videos from up here when we were at the 200-day moving average, this is when I started getting bearish and I shorted the heck out. And I got a lot of slack from people who were like, oh, you're trading counter trend, because, it was like breaking this resistance, but it was up against the 200-day moving average previous support. And, we were 50% back. It's like, I'm going to go back in the direction of this trend. I didn't know you were establishing longs there. See, this is where I get jealous of you guys that are not in the US, because we can't do that. Like, I can't start a core position long and then, try to be short at the same time. So
yeah, but here I am,
The market takes 102 to tango.
Yeah. I'm 500 pips offside on this trade, but fortunately I knew partly that when I was getting in near the top, so I started going in really small.
Oh, okay.
Really small, because there's that, yes, we're up at 75, 76, but I'm buying the top here. So if I'm going to scale in, I'm going to keep it small. And I've been playing the big figures and the levels on the way down on a more shorter term basis. Taking a little bit, getting stopped on the rest. It's been a bit messy. So I'm long at 70 15, 70 10, 70 05. I'll keep some as a short term play. I've already cut some out in the 32, and then I'll keep some in the long term pot and play the rest on a bit of a short term and see what happens. But on the short term, if we do break that 70, I'm looking to reverse into a short for a short term play. And
I think if we can clear 70 cents, I think we can actually see 68 cents again. And I got to use that loosely, because I really am thinking more like 69 cents. I'm not saying, we're going to, if we get, we've got to get really like a solid daily close below 69.50 before I start thinking 68 cents. But I think that's a risk. Don't forget, guys, the RBA is tomorrow, or tonight. Actually, it's tonight if you're in the US, tomorrow morning if you're in Asia. So that is obviously a risk right now, but I'm telling you this much: if we get back above 71 cents, I'm going to be more aggressive, and I'm going to look for a move back up to the 200-day moving average. Yeah, and then when Ryan goes to buy some, I'm going to sell him mine. So I'm just kidding. I'm joking. I'm joking. Hey guys, and K-Man, good to hear your voice. I know we've got we have an interview today, but since I did hear your voice, did you have any feedback about establishing positions as those levels come up? You've been doing this. You've been trading on dealing desks at the major banks across the world for the last 35, 40 years. What say you? How do you approach those situations?
Most has been said. It's about conviction. If you and I think yourself, Stelios and Ryan have been saying it. If you want to enter a position, look at what's going around. I'm a big fan of correlations. I'm looking at a lot of things. before entering a position, but when I have my level, I do get in because it's my level. I really have to get in, because if I wouldn't do it, I wouldn't be trading my plan. If you plan a trade, you have to trade your plan, at least for a part of it. And you can go in half, a quarter. As people will see on the ForexAnalytix, I'm really massaging positions in quarters, halves, thirds. But when I see my level, I get in, because I don't want to wake up the next day and say I've missed it and I didn't trade my plan. So I will always get in for a part of it. And then when the conviction plays, when the rest is as Stelios was saying, when the rest falls into place, then you just go ahead and you trade 100%, or in some cases, you see your level and you go like, okay, this is, as you are saying, a once in a generation occasion. I don't think it is myself at 70, but it can be
actually, what you probably misinterpreted me. I meant this low down here at 55 cents is a generational low, meaning that we're not going to get anywhere near that over the next 20 years. Yeah, I think you want to be long somewhere around here for a move back up towards 90 cents, or back up towards 90 cents in the coming 5 years, right? That's how I feel about it. That's what I meant.
Just on the dollar, can you go back to your screen that you just before on the Aussie? Here we go. The 2020 included, huh? If you go, you take the high in, what is it, the May June there, 2020.
May June
there, and then you have in May, I think May 2020, right, that one, and then draw a line over September, November lows. And you get somewhere around 67.5. I think if we ever get there, that's an opportunity not to miss, to buy.
Oh, okay. So you're talking about let me just throw a trend line here like this, so somewhere down here.
From the high in May, June, over the lows in September, November there. No, May, June.
May, June. Oh, whoops. I'm sorry. Over here.
That one. And then those lows in September, November. There we go.
Like this. Got it. Something like that.
68.
Yeah. That makes sense. That would actually take us to the 161% extension of this whole move right here. And also, I believe that'd be a 50% retracement of this entire move. So, or something very close to. So thanks, K-Man. I'm sorry, working into Dale's interview. Dale, I'm going to pass it over to you. I just want to thank everybody for being here with us today. If this is your first time here, just remember we do this every day, the first 30 minutes, just kind of rambling out and talking about, how we feel about the markets. But thanks for joining us today. And Dale, it's all yours.
Thanks, Blake.
All right. Thanks, guys.
Hala, welcome back to F.A.C.E. How are you?
Hi, Dale. Do you hear me?
I got you loud and clear. Great to have you back, Pavel.
Okay, that's great.
Are you going to share your screen? Little green button. And while you're doing that, Pavel, I have a decent memory, not, mainly about trades and what people are doing. Everything else, I can't find my keys, everything else. But I want to acknowledge that when you were on the first time, which was last time, you were taking advantage of not the natural gas futures market. You were buying shares in the natural gas sector, and they had a tremendous run up until a month ago. That was a great trade. Congratulations.
Yeah, thanks. In fact, we've been incredibly bullish the nat gas equities since autumn last year, when we called that the opportunity of this decade. So the latest run was just an extension of the move since autumn last year. But maybe in the short term we were lucky, but the general trend is definitely something that will play out over the coming years, not months. So
how do you view the recent weakness? Crude down $25 at one point was. from the highs, and natural gas has taken a pretty good hit too over the last month. In fact, I think it peaked maybe a week before WTI began to peak and pull back. So are these areas, after this pullback, you still believe in the ongoing bull market in that gas? And are you looking to buy this weakness that we have in those issues that you talked about last time?
Yeah, like I said, the bull market in energy is definitely a multi-year thing. But
Okay.
do not, as we also said, do not expect it to look like a straight line higher. The net gas is well known for its behavior like the VIX futures, when it's doing spikes higher only to sharply reverse lower. The point is that we expect the base of the price to move higher over the long term. And regarding crude oil, we were pretty bearish on crude oil in October because there were several signs that the market will weaken. The most obvious was the sentiment when people were calling for $100+ on crude oil, which
it was in backwardation then still, though.
Yes, it was in backwardation, but the point is, and I can show you the chart, the point is that the backwardation, so let's take a look, for example, at WTI contango. People used to say that backwardation means the market is strong. Yes, that's true. However, when the backwardation reaches an extreme, especially from the longer term perspective, that's usually a turnaround or the point of turnaround. You can see that the backwardation reached 4%. I have the chart in percentage terms because it's better for longer term analysis. You can see that the backwardation on WTI reached 4%. I have contango over here, so the backwardation is on the negative side of the y-axis. And that usually corresponded over the past 20 years to local peaks in the price, like here in August 2013 or here in 2008. It's not an indicator for precise timing, but that is the chart we shared on Twitter in October, and that was one of the reasons we turned bearish. So the correction is not surprising, and even if you do not follow any data, the sentiment was just crazy. I shared a tweet that it reminds me. I mean, when President Putin was calling for 100 or the price of crude oil over $100. I shared a tweet that it reminds me a similar call from 2008 when Gazprom was calling for crude oil over $200. So that sentiment was quite similar to that time, and that's the reason, maybe one of the reasons we're witnessing this correction on crude oil.
Okay, so I know I got you a little bit off topic. You came in with some VIX structure charts. Is that what you wanted to talk about?
Sure. I want to talk about VIX futures because this is the term structure chart of the VIX futures. We are mainly focused on commodities, but the VIX futures behave more like a commodity than a normal stock, index or these kind of things. And this is also something that's been in a spotlight recently because the stock market is correcting. And you can see that this is the data. This is the VIX term structure from Friday. And it's for the first time since late January when the entire curve is in backwardation. And this is pretty obvious, but I want to point out some details. The first one is that while the front is obviously elevated over the situation a week ago and a month ago, the back of the curve is also higher, but not as much as the front. That is normal, but when I take a look at the 5-year average and 15-year average of the VIX term structure at this part of the year, you can see that the curve the back of the curve was already elevated even prior to this sell-off, which was one of the warning signs we also pointed out on our Twitter and in our research. And that is also one of the reasons why this weakness in equities in the stock market will most likely continue. Here is the distribution of the first continuous contract on VIX futures. And you can see that after the huge sell-off in March 2020, it dropped roughly to 16, 17, which was pretty in line with the normal levels over 2018, 2019. And you can see that it's not far away from this peak on the histogram. However, the back of the curve, or the mid part of the curve, was much more elevated even prior to the recent sell-off, because it did not drop as low as the front. Even during the lows over July and August, it was well above the normal levels in over 2018 and 2019. And I also have the contango development over here. Here is the top subchart is the contango near the front between the second and first continuous contracts, while the bottom subchart shows the contango between the seventh and fourth contracts. And the front was moving, it was business as usual. It even got above 20%, which was the level we often saw over 2019, 18, even in 2017. But the back of the curve, the contango on the back of the curve, never got above the peak from 2017. The peak before the Volmageddon in the early 2018. So that was the sign that the market was not as strong. The volatility market, the structure of the volatility was not as strong as it was apparent from the front of the curve. And that's one of the reasons why I do expect another spike, backwardation spike into the negative territory, even on the mid curve of the VIX futures. So that's, of course, one of the reasons why we are still careful. Of course, there will be powerful rallies over the coming weeks. That's totally normal. But
Santa Claus maybe rally into the winter solstice and the Fed on the 20th.
Who knows? But right now, the data, the high frequency data remains very, not weak. Our, equity model is neutral. But the point is, it's very unusual to see the model to be neutral after such a sell-off over the past week. So I wouldn't bet on Santa Claus rally this year. Maybe it will look like more like 2018 when we got a rally after the Christmas. So who knows? The situation in the very short term, can be very unpredictable.
Bottom line, there's another shoe to drop in stock indices.
Yeah, definitely. And even if you do not look at the data, the sentiment is pretty clear. It seems to be that everybody's bullish. Everybody's looking to buy the dip. There's no real panic in the market.
Long-term bears, I've commented on long-term bears are saying, we'll get a 5% sell-off. We've had it. Then a new highs in January or a layup, and then we'll have a more serious correction.
Yes.
Do you think that's a possibility? New highs and then a more serious correction, or would you be looking more like for retracements of the first wave down?
I think the retracement is more likely, but this is just speculation. As I said, I prefer to stick to the data, and right now the data remains pretty weak, even in the very short term. So we may get another flush lower in the very short term. Of course, there will be a bounce. The rallies during these, large corrections can be brutal. But in the medium term, I still think we will head even lower. So,
medium term. What does medium term mean to you? 6 months?
Months, definitely. Longer than a month, less than a year, that's medium term. But once again, I prefer to stick to the data. So maybe we will get a strong sell-off and the recovery will come sooner, or it will be more of a multi-month drawdown, something like that. It's hard to predict right now, but the point is, and that's something we also told our users, that it's been a long time since we got a 10% correction. 10% corrections are pretty normal. Even in after the recession in 2008, there was a major correction in 2010 and then in 2011. And this is something we have not seen yet. Since
so there's a whole generation of traders that have never seen an extended decline.
Exactly, and I would say they have never seen bear market, because the event in 2020, that was not a bear market. Maybe in a strict sense that the price of S&P 500 dropped more than by 20%, but the valuation reset never happened. And I'm not calling for a bear market. Our long-term data still favors the bull market. So that's not what I want to say. But some, large volatility spike, that's something that is more likely. And definitely many people are unprepared for this, because there's extreme leverage, and even people who are not into finance are trading nowadays, and it seems that they consider the markets to be like free money. How
about the commercials? There'll be a football team out on the field, and some one who doesn't belong there will jump into the huddle, and they'll go, "Well, are you on the team?" And they'll say, "No, I invest in QQQ." Have you seen that commercial?
No,
it's been running for a few months.
No,
and then before this crypto break, you have Tom Brady trading crypto on an iPhone, and you have Matt Damon saying only the brave.
Yeah, I saw that commercial on Twitter. Yeah. I'm in Europe, so I do not watch TV. Basically, I don't have TV, but I saw these commercials like Matt Damon on Twitter. So this is really crazy, and even without TV, I saw it. I'm seeing it all around me. Even the friends who are, as I said, out of the finance industry.
Yeah, amateurs are geniuses.
Yeah, exactly. I tweeted yesterday that many people
and pros are amateurs.
Yes, I tweeted yesterday that many of my friends are heavily invested in Chinese stocks, especially Alibaba.
Chinese, wow.
Yes, and that's crazy. Of course, they are holding. They have large losses by now. And I simply cannot understand this behavior. So that's just a small part of the data. The sentiment.
Everyone has to learn lessons on their own, don't they, Pavel?
Yes, exactly.
They have to get hit in the head with a ball peen hammer to know it hurts.
Yeah.
So this was a major message that you had for us today, Pavel, and I'd heed it because what I saw last time. Was there anything market-wise you'd want to discuss, or you want to take some time to show your website and how people could follow you and perhaps get involved with you?
Of course. Basically, what we do is that we're developing analytics for financial markets, especially for commodity markets. This is the app, the Spread Charts app. You can find it on spreadcharts.com. So if you open our website, you can see, what we do, what our software is about. And you can, of course, sign up for our software. It's also available in free version, and the free version is quite powerful, unlike some other softwares that are very limited in the free version. So even in the free version, the spread chart is very powerful. You can access all the data, and also we do not have any annoying advertising even in the free version. So you can try it for free and see for yourself.
Okay. Well, Pavel, great call on natural gas, and there's some insight on what you're sharing today that maybe we shouldn't be in a hurry to re-enter stocks right now until what would you be looking for to tell you that it's close to over, like VIX 50, 60? What's going to tell you that there's been enough of a cleansing in the market to start tiptoeing back into it?
Yeah, so like I told our users many times, I personally have a Bayesian model for the equity market. It's my personal model. I developed it in 2015 when I was still, portfolio manager. And that's what I use to, look for the balance between the opportunity or profit potential and the risk in the market. And that's how I will spot the bottom in the market. At least I hope to. And my point or my goal is not to spot the exact bottom. I prefer to be late. I have no problem being somewhat late than being too early. That's the lesson I learned over the years. And what I want to see for the stock market to bottom is definitely some kind of volatility spike, especially in the structure of the VIX. So I want to see really high backwardation on VIX futures. I want to see some turnaround or clear turnaround in the bond market, especially the credit spreads, the corporate bonds. These markets are still weak. So I want to see definitely an improvement here, and that's just speculation. The Chinese equities or even the Japanese equities they are still quite weak. They are trending sideways. So the weakness came from Asia, definitely, which is, by the way, similar to 2020. It was very similar back then. So maybe I want to see this part of the market to bottom first. I don't know. This is not a requirement, but if that happens, if the Chinese market turns higher and the S&P 500 continues lower, so such a divergence would be definitely a welcome sign. So this is what I'm looking at, and once again I do not like to making predictions where the market will bottom, because it's just speculation. I was going to
change your last name and call you Nostrahala. No,
I'm not. I do not. I try to stick to the data. To have my predictions and decisions to be based on the data. Not on some speculation or tips.
Yeah, it sounds to me like you've learned all the lessons.
Yeah, definitely.
And sometimes more than once, like me, right, buddy? So anyway, I really enjoyed starting the week off with you, Pavel. Some great insights about, there might be a nice little reaction to sell in this market. And I appreciate you sharing your work with us, and wish you, happy holidays and a great trading season going into year end and beyond. And would love to have you back. So
thank you. You too.
Appreciate your work, and thank you for being with us and giving your time today, Pavel. Thank you.
Thanks for inviting me.
Okay, so that's gonna be a wrap, everybody, and you can find Pavel. His website and his Twitter handle are the same: spreadcharts.com, Twitter @spreadcharts.com, and check him out. That's why I bring in people like Pavel for you guys to, add some new tools to your arsenal of trading. So remember, don't just count your pips, count your blessings, everyone. You're welcome. Gorkum's thanking you, Pavel, and Monica. Interesting stuff they're saying. Galaxy. So have a great day, everyone. I'll see everyone for Turnaround Tuesday. Adios.
Bye.
Thanks again, buddy.
Bye. Thanks. Bye.